Investing actually is a risky venture, but the risk involved should not scare you away from investing. The best thing that could be done is to find a way of mitigating the inherent risk involved in investing. And one of the most effective strategy of tackling risk in the market is diversification. You diversify your investments across different industries, different sectors, and different assets, and sometimes, across different geographies or geographical locations. And so in this video, I want to talk about exploring geographic diversification. I want to look at opportunities that are obtainable across our own domestic borders. And I would like you to subscribe to this channel and like this video if you've not done that. I want to look at the features of geographic diversification, the characteristics of geographic diversification. Number one involve spread of investment across region. Spread of investment across regions. So you spread your investment across different geographic regions. In other words, you allocate your assets across multiple countries or regions and even continents. You can go as far as investing in the emerging economy. That will then help diversify away from, any given risky geographical location. In case there's trouble somewhere, that could affect your investment. If you have other investments, in other locations, your portfolio will not be adversely affected. Number two is risk mitigation. Risk mitigation. So it's kind of reduce your portfolio dependence on the economic and the political stability of a single region or a single country. In other words, if there's political upheaval, a kind of instability, in a particular region, your investment in other countries, in other regions could be doing very well. So it reduces your dependence on a single geographic location. Number three is exposure to diverse economic cycles. Exposure to diverse economic cycle. So it helps you to capitalize on varying, growth rates and business cycles across global markets, ensuring better portfolio stability. Different countries grow at different economic rates. So when you are exposed to different countries, you get to benefit from the different level of growth in the countries you've invested in. You're not tied down to a single country. If the country you are currently invested in, maybe a domestic country is not doing very well, maybe the economy is poor, it will affect your portfolio adversely. But if you're diversified across other countries, then of course those countries could be doing very well. That will affect your overall portfolio return and help to mitigate, risk tremendously. Number four is currency diversification. Currency diversification. It involves exposure to multiple currencies, potentially offering gains from favorable exchange rate movement. Once you are diversified, into different countries, you deal with different currencies that tend to appreciate at different rates. That will enhance your portfolio performance in a case where the currency of the countries you're invested in, are doing well economically. So it's very good because it guarantees that currency diversification, and it will help your portfolio to perform as expected. Not only that, number five is industry specialization opportunities. Industry specialization opportunities. Some regions, specialize in certain sectors. When you talk about technology, you are referring to Silicon Valley. When you talk about luxury goods, you are considering countries like France, or Europe, so they offer a kind of, sector-focused diversification. You talk about automobile, you're considering countries like Germany and Japan. So this particular diversification help you to spread your investment to cover countries where countries that specialize so much in a particular product. You want to really enjoy the auto industry, you can invest in Japan or maybe in Germany, depending on what industry you want to gain from, you want to harness your investment returns from. Number 6 is access to high growth markets. Access to high growth markets. This includes investment in emerging economies with strong growth potential, such as India, Brazil, Southeast Asia, and even Nigeria. We are considered an emerging market, though that is arguably anyway. There's that element of doubt, as we think, but we tend to perform better than some established economies, certainly. So you could diversify into a country like Nigeria and other upcoming African countries, other emerging countries. Number 7 is inflation and interest rate hedging. You help you to hedge against inflation and interest rates. So it balances the impact of varying inflation and interest rates. Interest rate trends across regions, protecting purchasing power. So in a case where a particular country, let's say your home country is facing inflation, you could diversify into other countries. By so doing, the impact of inflation on your portfolio will be less because of what you could gain from other countries you diversify your investment into, and so it hedges against inflation and against interest rates. Rates. Number 8 is broader asset class options. Broader asset class options. So it provides access to international equities, bonds, real estates, and commodities, as well as some alternative investments that may not be available in your own domestic country. In the case where, like in my own country, Nigeria, we don't really do options and trading, so you could diversify into countries that does option trading. It could be somewhat risky, but if you want to trade options, so you could invest in the US market for that particular reason, and so it helps you to it broadens your asset class. All right. So even in commodities, it's not very common in Nigeria. You could go to countries where you could invest broadly in commodities, And so not only that, number 9 is regulatory and tax diversification. Regulatory and tax diversification. So it helps you benefit from diversification in regulatory framework and tax incentives across different countries. In some countries, the tax rates, the corporate tax rate could be very low. Some other countries, their corporate tax rate could be very high. So if it is very high in your own country, you could diversify into countries where the corporate tax is low. All right, and so you would that would help you to have a decent returns at the end of the day. Number 10 is improved portfolio resilience. Improved portfolio resilience. So it helps you combine assets that may respond differently to global events, enhancing overall portfolio durability and market shocks. So by the time you are invested in different countries and probably different continents, you discover that your portfolio is kind of you will not really experience shocks that could be prevalent in your own country. All right. And so you have a resilient kind of portfolio that is not, really affected by what is happening in few countries around, because you are broadly invested in different continents and also in different countries. So you have a portfolio that can be considered resilient to economic shocks in other countries or other continents. Thank you very much for watching. Please don't forget to also look at other videos in my channel that talk about stock investing and investing in general.